Welcome back, everyone, to another Market Conversations. I'm Jerry Hall, and tonight I am going to be bringing in studio guest Santiago Velez. But before I do, I wanted to kind of set the stage with you tonight. You know, we're all on this journey to become better investors. And one of the things I was thinking about was it's a mindset, right? I have this investor mindset, and I've been speaking to so many people recently. And one of the topics that comes up is I just don't have a lot to invest, or I don't have money to invest. And one of the things that I started to think about was that there's this context for a lot of us, and it's easily understood why, right? Because of how we were grown up, the world we were brought into. But it's like there's this, we have to look and change our perspective. We have to frame things differently. And so one of the things I want you to think about throughout the show tonight are the three ways to make money, okay? You can, number one, trade something. You can make something, or you can own something. And for many, many, many years, I traded my time and my skill for money. There were even times where I attempted to make things. I produced a product. But very rarely did the things that I own actually turn into something. As a matter of fact, as I look back in my life up until the last 4 years or so, everything I put my money into was a depreciating asset. In other words, it just lost value over time. So I want you to think about that as I bring in this guest, Santiago Velez, who has traded his time for money and other things, I'm sure. He's made something, he's built a business, and I am sure as we take a 40,000 foot view of his investment strategy, you'll see that Santi believes in owning stuff. So without any further ado, let me welcome in a good friend of mine, Mr. Santiago Velez. Hey, Santi, how are you tonight?
I'm doing great. Thanks, Jerry. Thanks for having me.
Oh, man, it's always a joy to have you on the show and to interact with you in all the various ways that we've had an opportunity to chat about. I would like to get your thoughts on my monologue, the perception and thinking, both culturally and from your observation, these ways that we interact with value and how the predominant kind of perspective on how we acquire money.
Yeah, I mean, I can only talk from personal experience with regards to how I was raised, the values that were instilled upon me, which were useful, valued important things like education and family and things like that. But I largely was denied a decent education around investing and differentiating between a liability and an asset, and not understanding how to grow and compound wealth. And so it's one thing to invest in yourself, right? To give yourself a good education so that you can find good employment and make a living and have a fairly secure life in that regard. But what I discovered for me personally is that you remain kind of dependent on that ongoing process of, creating value for someone else. And once you realize that, you start to say, well, why can't I create value for myself? And what's the best way to do that? What type of activities and how should I devote my time to creating as much value for myself and my family as I can versus simply working harder or working more. So you hear that old adage about working hard and or working smarter, not harder. It really applies in terms of investing, so that you can use the power of math, right? Of compounding, of time, of just leveraging your personal efforts so that you get more of a return. And that's something I didn't discover until late in life. So it's never too late to discover that and go for it. Because, the most you have to lose, I guess, is that you make some bad investments, you lose what you invested, and then you have to go back to what you were doing anyway. I mean, that's really the worst possible outcome, is that you do what you were doing before, which is not really the worst thing in the world, right? So, I mean, for me, it was a big part of investing was letting go of the fear of loss. I feel like loss aversion is a huge thing that keeps people from taking a risk or from educating themselves. They just don't feel comfortable, and they don't have the confidence that you need to kind of tackle something new and different that you've never done before. So all these elements together, like I said, I didn't discover until very late in my life, and I hope that other people will discover it sooner, or at any point, really, so that they can benefit.
Well, I agree. And, one of the things that you'll hear, anybody that watches this show with any frequency hears me say this all the time. And that is, irregardless of your level of education, right? Financial literacy just is not a curriculum in academia. It just isn't. I mean, case in point, I'm sitting across here with Santiago Velez, who is a friggin' nuclear engineer. So I know you were up to your chin in math classes. And not one of them was about financial literacy or understanding, debt to equity ratio and the balance and how to put together models to look at, discounted cash flow and stuff. I mean, you might have taken a couple business admin classes, I'm sure. But for the most part, financial literacy is just not part of academic life, period. And one of the beauties about having a YouTube channel and having the internet is that we have access to the information that we weren't taught in schools. And we can come together as communities and share and disseminate that information so that we all get a leg up. So let's start off with, here you are, you've discovered a path of learning, you have acquired a financial literacy and continue to compound on that with every Real Vision interview that you conduct, every financial piece of intel or information you consume. From a 40,000 foot view, let's hear Santiago's kind of, ballpark investment strategy. How do you look at creating wealth for Santiago and your family?
Yeah, good question. I mean, I guess breaking it down to fundamentals is changing the mindset from where you spend whatever money you do have, regardless of the amount. It's a choice as to, do I use it to make my life better now, or do I want to delay that gratification into the future? And that's like step one for me. Is I'd rather, in a lot of cases, delay the gratification either for myself or my family, and then start making some choices around that. I'm not going to buy X, Y, and Z because it's really not as important as I thought it was, or it's really a liability. And in that sense, I define a liability as something that takes away value from me rather than brings it to me. Right? Something very simple like, my own home, for example, is a liability, despite it having a value in the market, and even if that value is increasing. The reality is that, it takes maintenance and upkeep, and it drains present value from me, right? So I derive enjoyment, I derive shelter from my home, but I realize that it's not really an investment in the sense that it's bringing value. And now it may bring value someday in the future if I sell it for or exchange it for another home and realize a gain. But you always have to live somewhere. So most people kind of, I think, look at their home as their main source of wealth or assets. And I feel like that's an error unless you're very clever and you leverage it somehow. And but in general, though, I would start there is just say, okay, what can I purchase that, or what can I do as an activity that will bring me value in the future versus enjoyment now, right?
Mm-hmm.
So you're talking about a vacation, or you're talking about buying a consumer product. The vast majority of the world is designed to separate you from your money, right? So if you just look at it from the framework of everybody's trying to sell something and separate you from your money, then you start realizing that, okay, maybe I need to be very careful with where I put it, right? And so that's my starting point, is just I want to buy assets and not liabilities, and I define assets as things that can bring me value either now into the future. So then the next question is, well, what kind of assets are there out there, right? So you can invest in a business, right? Which is, now everything I guess has risk and it has the potential for some return.
Right.
And how I build my investment thesis is that balance between my risk tolerance versus what I think that return could be. So you start looking at all the things out there that can derive value. You can buy a rental property, you can buy stocks, you can buy bonds, you can buy crypto, you can invest in your personal business, you can write a book and try to get royalties. Maybe you can create some content that again gives you royalties. You can start a YouTube channel and try to monetize it. So there's a large spectrum of options of where to devote your time, where to put your money to try and derive future value, and all of those come with a risk and a return. And so you have to take the time to understand each one of them and where you think the risk and return really reside, not what is kind of sold to you or told on CNBC or something like that, but really identify those risks and those potential returns. And oftentimes the best investments are the ones least talked about, right? Because there's a asymmetry in the market, right? Somebody is discounting how valuable something is, and that's an opportunity for you, right? If you think something's going to be more valuable in the future, and you've accumulated a bunch of information that supports that, then it's an opportunity for you if the price is low, right? And the old adage goes is you buy low and you sell high. I mean, that is as true and fundamental. It's really just more a matter of appropriate timing, and then deciding how long you want to wait to derive that value, right? What is your investment horizon? And then how much risk are you willing to take? And I also, of course, don't put all my eggs in one basket. I don't create an investment thesis around all in one thing, because that would be kind of irresponsible. And you want to plant a lot of seeds, so at least one of them has the potential of growing. And it's interesting because I know you're very much into the digital asset space, and I feel like this space in particular has an asymmetry in the risk versus return. The risks are very high and it's very volatile, but the returns, in comparison to many other asset classes, I've owned rental properties, I've owned stocks, I've owned bonds, but nothing has the risk return profile that digital assets have, or the asymmetric upside. And so it really then, just for me personally, it's knowing that, where then do I focus? Where do I focus the types of projects that I think have the greatest upside with the least amount of risk? So that's kind of my process, my thought process anyway. And then of course, not having all the eggs in one basket, I put a lot of my time into a business that I hope will derive some long-term sustainable future value, right? So on the one hand, you have a kind of a speculative investment, which you think has a very asymmetric upside. And then on the other hand, I'm working actively to build something that brings value, not just to me, but to others. And in those two ways, I feel that I'll be very profitable. So yeah, it's a very big departure from just being an employee of a company, working for a salary, kind of slowly building up my 401k.
Right.
And it's very exciting, very empowering. So.
Well, I'll tell you, so you and I both are products or children of baby boomers, right? And it didn't matter if you were in the United States or Europe or in one of the Asian countries or Latin America. After World War II, the sheer magnitude of the expansion of the population created a boom, because now we have there was just all these new people as they were going, that first wave of boomers entering the workforce, and the dream of buying your own home and that type of stuff led to this, and then it was followed by wave after wave after wave of that entire generation. And these aspirations, at least from the United States standpoint, was have your own stuff, get a job, have your own car, have your own home, have your own family. And to some degree, that was prevalent throughout the rest of the world also in different ways and means. Well, our parents learned that a home was a bank because of the population, right? The orders of magnitude of these baby boomers now having families, and those children, you and I, growing up and needing places to live. And so we're out looking for our place to live in our home. Homes took on the persona of a bank. And I can so distinctly remember my grandmother and my grandfather telling me how important it was to buy a home, because it would be this asset that I could have for my entire life, and that I could count on it going up in price. Now, for a large part, that was true. When you and I were children, that was still true. But something changed. Monetary policy changed. The way debt became the only way to beat, monetary expansion, right? M2 money supply. The only way to beat M2 money supply is to take on debt. So that meant home equity lines for individuals. That meant corporations taking out cheap credit to buy back their stock. I mean, it's just this cascade. And so what we have now, what you and I are faced with, is that it doesn't matter what fiat-based instrument you put your money into. They're all leaking like a sieve relative to currency creation in the degradation or loss of purchasing power. And so for me, like, I hear you about diversification, and I believe that everybody is different and they should understand the entire game and then carve out their slice that's best for them. I'm not a diversification guy. Like, my equity assets total maybe 5% of my total investments. It's all crypto, and most of that is Bitcoin. And it's been that way for the last 8 months. I have not put a new dollar into anything but crypto for the last 8 months, 7 months. for one reason and one reason alone, and that is it appears that the world has tapped Bitcoin as the winner in the digital asset space right now, and that it is a store of value. And I'm seeing that evidenced, substantiated with Paul Tudor Jones's, Michael Saylor's, even Raoul Powell's, on down the line. And I thought, you know what? I don't need to reinvent the wheel. I don't need to get cute or tricky. I just need to follow that money, because we're looking at the entire world being up against exactly the same thing. And that is a massively impacted purchasing power issue with our currency. Any thoughts on that? Or
Yeah, I mean, going back to the home as an asset for sure. Where somebody else's investment. So when you get a mortgage, you're expected to pay it back with interest, obviously, and so that's a bank or a lender's investment. You're the one who's going to take your productive labor, make it derive an income, and then pay interest to someone else. So it's not an investment to you; it's an investment to someone else. They're making money off you.
Yeah.
So the natural tendency then is to increase the amount of leverage that will be given to an individual, to the point where, as a fraction of their total income, the amount they spend on their home continues to rise and rise and rise, because they continue to lend and lend and lend. And as the rates go down, the cost of money is going down with it. So it's very inexpensive to lend and then derive a profit from it. So realizing where you are in the food chain, I think, is important, because then you can decide whether or not you want to participate in that way. Do you want to be the guy that pays off somebody else's loan so that they can be wealthy?
Right.
So I totally agree. I don't believe any longer. And if you look at millennials, it's very much a demographic mindset. A lot of millennials being saddled with so much debt. They don't even have the opportunity to participate in the real estate market. It's inaccessible from a practical standpoint, unless they make significant compromises on some of the features or size or locations. It's very difficult for them to participate in that same American dream, if you will, of the baby boomers. So they're realizing that, and they're finding yield and alpha in other asset classes. They don't. Gold is an anachronism to millennials, precious metals. That they're really not interested. That's their predecessor's asset class. They're fully digitally native, so it would naturally stand to reason that their growth will be represented largest in digital assets and that asset class. So and even equities to some extent is very much a baby boomer phenomenon. That on the tail end brought in people like myself, the Gen X and Gen Z generations. But millennials, they look at equities and stocks as kind of like gamification, right? This Robin Hood model of buying and selling like a game, just to try to get yield. The idea of a dividend, for example, is they're not in it for dividends. They're not in it for the same kind of discounted cash flow models that traditional investors might be. And everything is passive flows now. There's really no one that is going to consistently outperform the market at an individual level. The passive flows are so dominant that you have to be so exceptional in the equities market to outperform. It's just easier to buy an index. And that to me is a very dangerous thing, because it's kind of like an 18-wheeler on automatic. On super cruise control.
It just destroys price discovery. It just absolutely destroys.
Yeah, right. I don't know how to value some of this stuff. Yeah.
Continue. I'm sorry to interrupt.
No, it's just, yeah, exactly. If you use the traditional models of like a discounted cash flow or multiple of earnings, anything that one would use, say, in the 80s or the 90s. And all of the metrics it's incredibly crowded. And I think the reason for that is not because we have such a roaring economy. I think it's because it's a crowded trade out of desperation. I mean, we have a global market that is in dire straits, and really, it's a crowded trade for people who are seeking safety. And you see that concentration. It started first with the U.S. markets, and everybody was leaving, emerging markets and international markets and coming into U.S. markets. And then you saw it further concentrate into the FANG stocks. And so it's really people are trying to find shelter among each other in a pretty desperate situation. And that's just not a game that I'm interested in, because I don't have a trading algorithm. I'm not a high frequency trader. I can't trade at scale with large amounts of volume. I don't have access to the best rates. So to me, that's just not a foundation that I want to build on for an investment. I would rather find a small emergent asset class that has, like I said earlier, an incredible upside. Because we talked on Twitter about this, Jerry, about the idea of network effects. And the way I view equities is that it is a network of investors, right? It is people who have decided to participate either actively or passively in buying shares of companies. And each one of those companies and the kind of the stock market as a whole is this network, and they buy and sell and they trade against each other with brokers and whatnot. And there's always other networks that they exist in relation to. So there's like the fiat network, right? They can always trade out of their equities into dollars so they can buy things or whatever. And then, of course, you have much smaller, significantly smaller in market cap networks like cryptocurrencies and digital assets, right? These are new emerging technologies that are so small in relative size that the outflows from one network, whether it be the fiat network or the equities network, can have such an outsized percent return on the digital asset space that it just seems to me like that's where you want to position yourself, right? You want to position yourself wherever the largest gradient is. So it's no wonder that, for example, Bitcoin, if you buy into Bitcoin when the price is low, eventually the price gets to a point where the gradient between the Bitcoin network and the fiat network is sufficiently steep for existing participants that they decide to flow backwards, right? They decide to sell Bitcoin and go back into fiat dollars. And so I tend to look at the investment as, okay, where's the best gradient? Where's the best arbitrage for where I think the flow is going to go to next, and try to preemptively position yourself in that spot, right? And be patient. It's almost, I call it crocodile investing. Crocodiles here, they go like two years without eating. They're just waiting for a meal because they position themselves in a place where they think they have a large opportunity to catch a prey. I feel like digital assets is very similar in that it's a new asset class. It's very compelling to millennials. It is very illiquid and small. And as a network, it continues to grow nonlinearly, exponentially, and in relation to other much larger networks is significantly positioned for a large gradient flow. Right. So that's how I look at it as like an engineer. And it seems almost like a venture capital, but for retail, right? So retail's never had an opportunity to be in the venture capital space, but that's how venture capitalists essentially operate. Is they'll invest in a Facebook when nobody knows what Facebook is, and they will make they'll take a large position, and they understand that the gains from that position could take several years, but they'll see, they're not going to see 20%. They're going to see 10x. They're going to see 30x when the thing finally goes public. That's what they're positioning themselves for. And they won't just, invest in one company. They'll invest in like 6, 7, 8, and one of them will be a unicorn. And so that's kind of a venture capitalist mindset. And it can be very lucrative, obviously, as Andreessen Horowitz and others have done so well. And I feel like crypto is the first opportunity for retail to really participate at scale in that same style of investment, right? Rather than just this long, slow, steady growth in equities or bonds.
I agree 100%. I've really taken this thought process, right? I'm looking through a lens now that's kind of been handed to me by both Jeff Booth I don't know if you're familiar with Jeff. He's the author of The Price of Tomorrow. And Michael Saylor, not only the CEO of MicroStrategies, but also the author of The Mobile Wave. And it is in both of those gentlemen's works that I've consumed and I really, really like, is the understanding of the value of a network, right? And there is a point, it's like an inflection point where the network is here. It's not a passing fancy. It is not most likely going to go away tomorrow. And I believe in the digital asset space, we've found that with Bitcoin. I think Bitcoin has established itself as a monetary network that has an addressable market of the entire globe, right? That's every man, woman, and child as an addressable market. And I think that's good enough for me right now. Now, do I have some bets on some other stuff? You gosh darn tootin' I do. I love the whole concept of programmable money, right? So I'm like, I like Polkadot. I like Ethereum. I like Cardano a lot. I mean, a lot. I like VeChain a lot. And I have a couple other assets that are make up my portfolio, but my big bet is on Bitcoin growing, and the fact that the world is experiencing this real productivity. Like, where is the productivity in the world? Where's the growth in the world? It's in the taking things from the material world and dematerializing them and get them on a network that the whole globe has access to, right? Well, I don't know if you get any more dematerialized than Bitcoin as it pertains to value, right? The dematerializing currency. Now, we have some other suitable assets that do that very well. XRP and XLM are great for payments. Will they take off? I don't know. Will stablecoins do that? I don't know. I don't see an investment in stablecoins for myself, so I don't invest in stablecoins. But you know what I'm saying? This taking a network that has a very low variable cost to its users and opening access globally seems to me that whatever businesses are built on that, whatever assets come about from that, are going to have the highest chance of success because they're having the lowest hurdle. They don't have the same overhead that, let's say, a Ford Motor Company has. Am I nuts, or do you think I'm onto something with this?
No, I am 100% agree, and I would add that the fact that there's so little friction in participation, meaning it's extremely easy for people to participate early, is such an important factor because those on-ramps are what allow the network to grow at such an incredibly fast rate that people can participate in large numbers and in large quantities relative to the networks that they're leaving. So it doesn't take very much to drive Bitcoin, 30, 40, 50% versus other asset classes that are far more liquid. It takes massive inflows to drive them to that amount. And that means it takes a lot longer to see the return of your investment. So digital assets from even though they are venture capital type investments, right, that you have to understand the project and what they're trying to achieve and the problem they're trying to solve. And it could take time to see that. When they do finally manifest their value, the rate at which they do in like a quote unquote bull run is vastly greater than any other asset class that anyone's experienced, except for venture capitalists. Now, I think Bitcoin is actually at the point where you would call it an IPO. Right. So a venture capitalist journey is investing for the IPO so they can have a big liquidity event. And what does that mean? They sell it into the public market so that they can exit with, billions of dollars. And I think that's where Bitcoin is now, where there's enough confidence around it as an asset. It has enough pedigree in terms of its history. It's seen enough ups and downs. It has regulatory clarity. and there's a general consensus around it that it's a you know, it has this brand of being a store of value, right? So it stands to reason that it's symbolically in its IPO phase. And what that means is then that institutions are at a point where they feel confident enough to participate in it and try to find ways that they can enter the space without causing even more slippage, right? More appreciation beyond a point where they you know, it's like they're giant whales and they're trying to jump in this little tiny pond. When they do, they make a giant splash. So you want to be in that pond before they jump in. And I think Bitcoin is at that point, right? We're reaching an inflection point. But in terms of total return, I actually don't see it as that attractive. If you're looking for an asymmetric upside, Bitcoin, of course, is going to do well. You're going to probably, you know, 8 to 10x at the next at the high for the bull run. So we could see it go to $150,000, $250,000 per Bitcoin. But you know, you look at something like Ethereum, I think it will actually outperform Bitcoin by a large amount. And I think a large number of quote unquote small cap digital assets. So I divide digital assets into like a large cap, mid cap, and small cap. And largely those are time based. So small caps are those really new projects that are third generation technology, you know, very speculative. Nobody knows if they're going to actually even make network effects to persist. And that's what I categorize as small cap. Mid cap are those projects that are kind of second generation. They've already cultivated a pretty decent network effect and are very likely to persist, but they're not yet at that IPO phase where they're going to see institutional adoption at scale.
Right.
Also a great opportunity. And then obviously the large cap as, you know, Bitcoin and Ethereum as the two with regulatory clarity and the two that have this narrative that institutions are very comfortable with. So I tend to break it down as those three, large, mid, and small cap. And the returns from each of those is going to be very different. The small caps are going to have vastly greater percent returns. However, the risk is higher, right? If they don't acquire the network effects they need to persist, then it's a gamble, right? That you'll just be wrong, and you know the project will fail just outright. Whereas the mid cap ones, there's a pretty good probability that they will persist, but they'll definitely outperform Bitcoin. And so that's the kind of space that I'm most interested right now. Is a little bit of the small caps, like 20%. And then a good fraction in the mid caps, somewhere around 60%, and then the large caps, you know, the remainder. And that changes, of course, with you know, whatever's going on. And if you keep your ear to the ground, whatever's going on, that balance changes. And of course, that balance changes when you go from you know, Bitcoin season to quote unquote alt season. And now I would actually group Ethereum along with the Bitcoin quote unquote Bitcoin season. And no longer with altcoin seasons. I don't actually see Ethereum as an altcoin anymore.
Interesting. You know, one of the things that, and I want to make sure that everybody in the audience knows, if you have a question for Santiago, put it in. And Brady, are we capable of taking live phone calls? Do we have that tech up and running, Brady? If we don't, if you have a question for Santiago and you'd like to come in studio, we are more than happy to send you a link. You can come in and ask your question on air, and look for Brady in the chat to let you know if our phone line is up and running. You know, Santi, we could go all night just talking about assets, but you are a very interesting man, and I would love to get your take on what it's been like to get to interview some of these incredible people for Real Vision. Greg Kidd, Hugo from Flare, JP from Uphold, and I forgot his name, I apologize, the guy from Quant. You have been hitting home run after home run after home run with these guys. Let's talk a little bit about what it's been like for you to kind of becoming a celebrity interviewer in a way.
Yeah, I'm spoiled. I no other way to put it. I had an opportunity that Raul gave me with after our first interview when he interviewed me, and through it was just by chance that we wanted to talk live on his channel, and the general theme from that interview was this idea of Internet of Value and of interoperability. And since that point, what I focused on very, very strongly is kind of the projects that I feel are in that direction, right? That the ones that they're supporting interoperability, the Internet of Value, this idea of a currency agnostic world, a protocol agnostic world. Very soon I'll be interviewing the CEO of Forte Games, and one of the topics we're going to be discussing is protocol agnosticism, right? That if they do create games that operate with blockchains, that developers who make games don't really care about the blockchain and don't want to worry about the underlying tech stack. And so what Forte is really trying to do is build this bridge that a developer can proceed with confidence building a game, which is what they're interested in doing,
right?
And then have it interoperate with whatever blockchain is appropriate. So they don't have this sunk cost, or if the ecosystem collapses because it doesn't sustain its network effects, that they have the switching costs, or they're not able to maintain the proficiency necessary to constantly maintain this interface, this bridge between their game and the underlying blockchain. What Forte Games is doing is trying to create this layer that abstracts that away so that the developer can focus on developing good games, but allow the use of blockchain as a tool for making like tokenomics and things like that. So in general, all of the interviews I've done have been a very selfish attempt as a personal investor and a curious person to learn about these projects that I think in the long run have kind of the greatest potential for creating value for the world, for the ecosystems they're in, et cetera. So I've been very targeted at the types of people that share those values, that way of looking at the world. And it's an incredible luxury to be able to ask questions of those people, and it's almost like a class for me. I get to sit down with them and learn from the experts directly, and I think that's the best way to learn and then make a decision around investing. So it is very selfish. Like I'm not going to pretend like I do it because I want to learn about the project and decide if it's something that I want to participate in. And then also kind of get a view of where the future could go, so I could create a better framework for myself. And then, with the hopes that the audience gets to learn alongside with me, right? They're there right next to me in this class, and I'm trying to ask the questions that I think they might be interested in, so that we can learn as a unit, as a group. I'm just so lucky. What can I say? I'm very lucky.
Well, I'll tell you, that's been my approach for my channel since day one, is to basically in real time have my journey to financial literacy. And so every guest I've ever had on, whether it's a community member from Twitter or somebody that I saw do something on Real Vision, or somebody from the crypto infrastructure space, it's been all about, I'm interested. I'm truly interested. I'm not out interviewing people because I think that's what the community wants, although I hope that they do. It's really a selfish thing, and I can completely relate to that. I also want to throw it out to the chat here. Is there anybody that has any questions? Get them up on the screen. I haven't seen any. I saw Brady put up that you can do something on Twitter. Send them a message on Twitter or something of that nature. Anyway, you know what? How about we do this, Santi? Because I thought your interview with Hugo from Flare, and I've seen him do 3 or 4. I saw it, so I've got 4 or 5 hours of Hugo under my belt. And I thought the interview you did with Hugo was brilliant. Let's take a couple of minutes, and we'll do this with a few of the other guests that you've had too. What was your takeaway? So I can honestly understand how you approached it. Let's talk about your takeaway from it.
Yeah, I had three big takeaways. The first was that they're building it with a certain total addressable market in mind, right? They're designing a system that they want it to be enterprise grade ready, and that means that they're not really looking to build a system that just retail builds on, but that large corporations or trading desks or market makers or really institutional grade performance can build on. And I think that's a very important approach because the creators of Flare come from institutional trading. So they see kind of the problems that exist and they see where this technology can create those solutions. So that to me is my first big takeaway. It's like it's enterprise grade ready right from the start. Second is how clever or how much thought they put into addressing a lot of the problems that the first generation of blockchains had in terms of scalability, distribution, incentive systems, being able to make it as easy as possible to port over existing sunk costs, right? Efforts, right? Like if you take a developer from Ethereum, why would a developer from Ethereum relearn an entire new programming language to build smart contracts on another platform? What is their incentive to do that? And how much time and effort would it take for them to do that? So I thought it was very clever of them to say, hey, we're just going to use the Ethereum virtual machine. So day one, if you did anything on Ethereum, you can literally port it over to Flare. I mean, that's a master stroke, right? And then, in terms of the settlement engine deciding, hey, we want to create, we want to use Avalanche, which is like a third generation Byzantine fault tolerant settlement layer for high transaction performance. So all those little pieces that, they took all these very sophisticated approaches to each piece of this puzzle and put it together into a system that I think has an incredible amount of potential. And then the thought that they put into the incentive structures to shift the mindset from one of HODL, right? Almost every other blockchain has a HODL mindset. Like you buy the digital asset and you store it in anticipation for selling it in the future. And
Right.
what they're saying is, no, we want to change the incentive structure that it makes it a negative incentive to HODL, right?
Right.
They want you to use it. They want you to be a liquidity provider, convert F assets, all this stuff. So that is super. I think that's very interesting. And then finally, they're very dedicated on gaming. I think they see the future of gaming in terms of the first big at scale use case for retail grade crypto. So it's funny because they have a platform that's good for enterprise grade use, but it also will be ready made for the tokenomics that gaming systems will rely on, which are very high transaction tokenomics, right? Like if you have a game, you could have millions of players trading digital assets, trading services, goods within the game universe or economy. You need very high performance systems that are reliable with low counterparty risk to facilitate that. So I think it's brilliant. So we'll see. It's on them to prove themselves and get it out as promised. So I'm still skeptical. I'll remain skeptical until it's out, but I plan to build things on it personally.
Really? Would that tie into Lori's question here? What are your favorite projects? Would you say Flare is one of your favorite projects?
Yeah, well, as far as the design, sure, of course, yeah, I think Flare's great. But breaking down into those large cap, mid cap, small cap, my favorite projects in the large cap is definitely Ethereum. I mean, if I had to pick between Ethereum and Bitcoin, I still go with Ethereum just because I feel it has a larger, outsized return. So I'm just talking from a purely investment perspective, not a ideological perspective.
Right.
I do think Ethereum is vulnerable to attack from other networks that could offer the same things like Flare, but with lower trade-offs. But from a large cap, I still would pick Ethereum over Bitcoin from an investment perspective. From the mid caps, I'm still very bullish on XRP, despite it not being the popular coin right now, I'm very bullish on it. Actually, I'm hoping that at some point I'll be able to arbitrage Ethereum for XRP. And then as you get it down in that mid cap, I'm very excited about projects like Cardano, some of the Polkadot, anything. Again, this theme of interoperability and creating bridges. Because if you look at investment as a framework of deciding which network to participate, I have my fiat network, I have my stocks network, I have whatever crypto network. I feel like any project that's trying to bridge these networks is going to be the beneficiary of flows. They're going to see the liquidity move from one to the other over their platform. So that naturally lends itself to good price appreciation. And so, things like Polkadot and other interoperability frameworks, Chainlink, things like that connect things and solve a problem, I'm very, very interested in. And then when you get into the small caps, the really small projects, I'm very bullish. Quant, obviously, I interviewed their CEO of Quant, Overledger. Again, that's another interoperability. And in terms of market cap, they are where XRP was, back in like 2013, right? So from an upside potential, I think it's very asymmetric. And then, of course, things like Fetch AI, very, very interesting. Other projects like decentralization projects of the internet itself. So things like Filecoin, storage, things that relate to video, for example, video transcoding. So that's things like VideoCoin, FilePeer, Theta, things that are progressing the internet forward into Web 3.0. I'm very passionate about. So yeah, that's how, without naming all of the things that I'm looking at, that's how I break it down.
Well, I'll tell you, I have been, I haven't had a lot of money to invest. But recently, I have a little, and I took a play on a web token called Holochain, who are trying to create a decentralized internet. We'll see if they're successful. But I liked the team. I did some research. I liked the protocol, and I think they're at least what they're doing is honorable. And we'll see how successful they are. But when you talk about projects that are in that like micro cap field, it doesn't take a lot to have a big position. $100 can get you 200,000-300,000 tokens. And if you can find a place where you can park those tokens and earn a return on asset with them, then it doesn't matter how long it takes. If it takes 3 years, 4 years, okay, no problem. I got no problem with that, because my whole portfolio isn't geared to one thing, right? Anyway, I'm going to cut this short. I don't think we had Bitta as a regular guest, your first appearance on the show, Santi, but our lady on the street, Bitta Avenue, is just popped in the studio, and I want to welcome her to the screen. I'm sure she's got some great questions for you, Santiago. Well, hello,
Hi.
Bitta. How are you?
Good. Happy Friday, everybody.
Absolutely.
How are you?
Your thoughts on the show so far and any questions you have for Santiago?
Yes, it's been a great show. I've been listening in the background, so it's been great. I have two questions addressing one, the stock market versus the crypto market as far as like investment is concerned, and I also saw somebody actually had a similar comment that I wanted to address. And the other question is going to be regarding cashing out versus staying in and hodling. So the first question that I have is, especially for people that are new to investing that don't have anything in the stock market or the crypto, why would somebody want to get into the stock market when they're just fresh, like just starting to invest? When the returns with crypto are I guess higher, or that's where I feel that the world is going. What would be the advantages outside of just diversification?
I honestly, I can't see an advantage. I don't participate in the stock market anymore at all because it just doesn't make sense to at that price. Most of the companies are trading at valuations that are ahistorical. We have not seen them that price that high. And as an investor, I'm getting less for my money. I mean, that's one thing people don't understand. When the stock market continues to rise, yes, it gives you a nice feeling that you're in good company with all these other people whose wealth is going up. But the reality is that you're buying companies, smaller and smaller fractions of that company. So for the same dollar 6 months ago, you're getting a smaller fraction of that company. And I just don't think that's a sustainable model for long-term wealth creation. I think at some point, the rug is going to get pulled out from the stock market. And I think we're going to see a massive correction. We'll probably have a melt up first, meaning we'll see an incredible appreciation in the stock market, and then a massive correction. And a lot of that is predicated on things that I have no control over. I can't anticipate. And even some of the smartest, most heavily funded people on the planet can't anticipate it. So it's just not a space that I'm interested in. Whereas crypto, I feel, is manageable in the sense that we're all here at the same time. Like, I'm not privy. I have access essentially to the same level of information that someone at an institutional level might have access to. In fact, I would argue that a lot of retail investors have more access to information at the in the crypto space than institutional investors, and are ahead of the game in that sense. And so, as a millennial, I wouldn't put my money in equities. I would absolutely look at more mature in crypto projects, but again, with the idea that, and not to be cliche, but never invest more than you could lose. But realistically speaking, so if you do have disposable income and you decided not to buy, Starbucks coffee for a month or whatever it is, and you put enough money aside and you do lose it, it's not the end of the world. You can go out and create more value in your life. But the upsides, I think, can have a life-changing effect, whereas the downside probably will not. So that's how I look at it. I don't know if that answered your question or not.
It did. And the other thing, I guess, going off from the same question would you look at the trading, options for, whatever type of trading that you're doing in the traditional market? Would you look at it the same way as you would look at long term holding of the stock that you're buying?
Yeah, good question. I mean, in crypto, for example, I don't think trading, unless you're a really good trader, in other words, the top of the class, like Six Sigma level capability, I would not recommend trading for anyone, because crypto is a highly manipulated market. And there are algorithms out there that are constantly scanning for stop losses and leverage, and they're just actively seeking to try to stop people out and have them lose all their money. So in crypto, I would not recommend trading for anybody. In fact, if you look at Bitcoin, it's never been in a bear market.
Okay.
Bitcoin has been in a secular bull run. Oh, go ahead. Yeah.
Okay, sorry. I was actually thinking trading in terms of the stock market, not the crypto world. Yeah.
Yeah, I would not recommend anyone trade the stock market because, again, there are high frequency traders. There's a lot of front running. If you do like Robinhood trades, for example, the reason Robinhood trades are free is because they sell your trade information to high frequency traders. So if you put an order in for a share for $100, that high frequency trader is going to go buy it for $99.50. And so by the time your order gets to the broker, you've already lost 50 cents because that high frequency trader just made it got in first. You will never beat that. You will never beat that. So if you're getting something for free, it's because you're the product. So I think Robinhood did a very good job gamifying stocks. and making it fractional so that they're accessible to millennials, they're affordable. But the reality is that they front run that trading information at scale. That's how they make their money. So you're the product, and again, only the most exceptional are gonna beat the market. And ultimately, you're gonna reach a point where you could lose a significant amount of your wealth. Now, you may compare that to crypto and say, well, crypto, that's true too, right? And with crypto, I would say you just hodl. If you find a good project and you think that it has the network effects that it has to persist, then really you can't lose as long as you wait. If you wait long enough, what we've seen with 10 years of crypto history is that eventually you will make outsized returns. It's just a matter of your horizon. So short-term gain, I'm not in it for any short-term game. I've never been in it for a horizon less than a year. Everything that I do, I try to at least set myself up for more than a year for tax reasons, first of all, because if you do sell crypto at less than a year and you've made a gain, you're gonna pay the government a large fraction of that. Whereas if you hold for at least a year, right there, you're saving on your tax loss. And then again, the long-term secular trend in crypto has been bullish. I mean, beyond any other asset class on the planet. So.
All right, awesome. Thank you for that. And my last question, I guess, is when it comes to, I understand that everybody wants to huddle, and so do I, but I keep going back and forth. Is it worth, especially when we're having, every 4 years or so, we're having these bull markets where everything is going up and you're not taking advantage of the run up. What are the disadvantages of not taking advantage of it, because it's going to come back to the same place that it was or a little higher, but you have not taken you haven't realized your gain. So is that worth the loss versus you putting it in a participating network where you're getting a percentage but your value is a lot lower? So wouldn't the run up actually not gain you more? So how do you look at that?
Yeah, absolutely. I mean, I think anybody that came in 2017 realizes that you should take gains. If you have a gain that has a substantial impact on your life, or that you've met certain investment goals, take it. There is no shame in selling a digital asset to make gains so that you can improve your standard of living and make your life better. That's the whole point of investing. You can't take it with you when you die. And if trying to leave a legacy for your family, that's one thing. And that there's a virtue in that. But at the same time, and I'm very aligned with Raul Pal on this, is we invest so that we can live a good life. And if you see that the price appreciation is an opportunity for you, by all means, sell it. You're not becoming a day trader just because you want to take gains off the table. You're being a savvy investor, and you're going to get some of that fiat and use it in other parts of your life that are very important. For me, for example, in the 2017-2018 bull run, I sold a good amount of crypto because I then took those funds and I'm now able to invest it in a small business. So, again, it's how long is your horizon? I don't look at my horizon as day trading or weekly. I don't really try to time the market, but sometimes it's so obvious, right? If Bitcoin's past its at the high and it's doubled and you're at 40,000, by all means take gains because you'll have another opportunity to buy in later. We know that those things are a cycle. You've seen 4-year cycles. You can look at the data going backwards, and they always go back to the intrinsic network value. So if you've seen the Bitcoin cycles, you get these bull runs, and the speculation will drive the price way high, relatively speaking, and then it intrinsically goes back to what they call a stock to flow, and that's really a reflection of its network value. How many participants have stayed in the network, not just for speculative reasons, but have stayed in it, and that's the opportunity to buy again. So I try to sell at the highs. Of course, everybody wants to sell at the top, but you don't need to sell right at the high. You can make significant gains, and then I try to buy when we kind of go back to that long-term secular bull run, which is the stock to flow or the network effect, however you want to model it.
Right on.
Awesome. Those were my questions. Thank you.
Right on. Well, Bitta, let me bring you in and get your last thoughts. Then I'll bring Brady in and get Santi's last thoughts. We'll close with Brady's last thoughts, and then I'll have a last thought, and we'll let everybody go about their merry lives. So, what do you got to say for yourself tonight, young lady?
Well, those are the two questions that me and a few of my friends have been not arguing, but discussing back and forth, going back and forth about. So now that I can go back in peace and say that I can back it up with a video now. So it's a proud moment, right?
Right on. No, I'll tell you what, Bitta, the fact that you're having conversations with your friends about investment is, to me, heartwarming. When I was your age, I was only concerned about the kind of car I was driving, what new accessory I was getting for my motorcycle. Was I going to go water skiing on the weekend? That was his, you know what I mean? I wasn't thinking about how can I stay ahead of inflation? How can I have my dollars that I earn create something for me later? Right? How can I have my dollars make more dollars for me? So just the fact that you're doing that is incredible. You're on a journey, as we all are on a journey, and we come to this in different places. So keep that thought, and we'll see you backstage in a minute. Okay, kiddo?
All right.
Santi, your final thoughts, young man.
Be says incredibly skeptical. Just consider everything that you hear, no matter from whom, from me, from anyone else. Just assume that it is incorrect, and approach as much as you can with as much skepticism as you can, and then go and find for yourself the level of information that you're comfortable with before you do anything, whether it's selling or buying, in both directions, because there's a massive media engine designed to separate you from your money, manipulate you emotionally, and you the only people who can do that is you. Like no one can force you to buy or sell. Only you could do that. So if you could control yourself and your emotions, and you can approach everything with a healthy skepticism, I think you'll be, safe and much better off.
Santi, thank you so much for taking the time away from your family to come and share with us tonight. Your friendship is very highly valued by myself, and we'll see you soon, my friend.
Appreciate it. Thank you for having me, Jerry.
Pure vida, mi amigo. Hey, Brady, are you going to pop in here and give us your final thoughts? Ha-ha! There's the answer.
Yeah.
All right, Brady,
If I
talk
can push
to
the button. All right, I have a short one because it popped into my head when we first started talking, and it was about relationship with money. So I think everyone should ask themselves, what's your relationship with money? Is it valued over your time or under it? Learn how to value your time so you know its cost. And I've been doing a lot of that lately in, the day job, sitting there wondering, I could be thinking towards my own benefit and doing things to benefit the direction I'm pointing in, or I could be doing what I'm doing now for, XYZ dollars. So it's now that I can pick an asset and an avenue to collect it, it's homework time. So I hope everyone asks themselves and those around them their relationship with money and time, because we only have one of them on the earth and we're trying to collect the other. It seems kind of weird. So that's my story and I'm sticking to it.
Right on. Well, Brady, Santi, I'm going to put you backstage. You guys hang out for the after show. I'll see you in a second. And folks, I basically wanted to close with this. There's good news and there's bad news. And I'll give you the bad news first. The bad news is the era that our baby boomer relatives grew up in, where you could go out and earn a living wage, provide for your family, acquire things like homes and things of that nature, it's becoming only accessible to a very small few. And that's just the truth. We're living in a world where between monetary policy, fiscal policy, deficit spending, credit cycles, inflation as a whole has, it's forcing all of us farther and farther and farther out on risk curves. More and more and more of us are becoming, like Santiago said, the product. Well, there's also good news. The good news is that there is sound fiscal policy. We call it governance on a blockchain. There is good monetary policy. We call it governance or tokenomics on the blockchain. And we have evidence that networks that provide sound value expand exponentially. I do not think I pronounced that correctly, but I made sure not to put a D in it. We have an opportunity to get value into these ecosystems and watch them flourish. None of us will know when the inflection points will happen. It's under debate whether Bitcoin's at that inflection point. I may say it is, and somebody else may say it isn't. The fact of the matter is that there is a safe haven for us. There is innovation, and there's a need with an addressable market of the entire world. So if you're tuning into this channel, you've got some skin in the game, and you continue to reach out, whether it be through this channel or through other means, to continue to bolster your financial literacy so that the decisions that you're making are being made because you're learning about sound best practices. You're learning about principles. You're being able to discern whether you're the product or not. I want to thank you all for tuning in. Hit the like and subscribe button on your way out. And I'll see you guys next week. Pura Vida.